The reason I like gold is it has a 2,000-year history of doing what I know it's going to do, right? Which is people have treated this as the safe haven regardless of what other currencies were doing. And I believe that gold is the most stable currency. So as a result, I think it's a good asset. I think we're more likely than not to have higher inflation the next 2 decades. And as a result of that, gold will outperform at least all currencies that I can think of.
Gold's value is derived from scarcity as a commodity, as well as it has been used as a reliable way to trade things for a very long time. When there is economic uncertainty or when prices are going up a lot, the price of gold tends to go up too. So, people often turn to gold as a safe and stable investment during uncertain times or when prices are rising quickly. In an interview with Stransberry Research, Daglio, CEO of BC Gumps, predicted that we will experience higher inflation in future, and because of that, gold will likely perform better than any other currencies. The Bretton Woods system was an agreement that ensured countries had to keep their currency's values close to a set rate compared to the US dollar. The US dollar could then be exchanged for a specific amount of gold. David believes that we are now 40 years into an experiment called Bretton Woods 2, and Powell's job is more difficult because of this. For a long time, the US dollar has been the most widely used currency in the world. About 60% of the foreign currency reserves held by countries are in dollars. However, its dominance has been slowly decreasing over time, which have made it easier for other currencies to be used for global transactions. In recent years, the U.S. Federal Reserve has been raising interest rates aggressively to combat inflation within the country. David believes that it may be better to focus on owning more commodities, which can act as a good protection against market volatility. During a bear market, when the stock market is experiencing a decline, David expressed that when the stock market is going down, I prefer investing in commodities like gold. Let's watch snippets from David Daglio's interview, but before getting into the video, make sure to subscribe our channel and give this video a thumbs up.
I think the Fed, I think Powell has the worst job of any Fed chairman in the last 40 years. And the reason, Daniela, is because we're 40 years into the Bretton Woods 2 experiment. And if you'll give me just a second,
Yes.
A lot of your forecasters talk about gold and what can happen. I think before you can understand currency, you need to understand the purpose of Bretton Woods 2. So Bretton Woods 2 was an agreement where we basically moved off the gold standard. And what happened in the first, say, decade of Bretton Woods 2 is we were very cautious around money printing. We have an inflationary problem. But then politicians said, geez, since we don't have to, if we could print more money anytime we want, doesn't that mean we could spend more than we take in? And that started a current account deficit for the United States, which, as you know, started in the late 80s and has been running ever since. Effectively, what we did during the second stage of Bretton Woods 2 is we bought goods from China, we shipped dollars over there, and they bought our treasuries in exchange. And the world was happy with that. I mean the Chinese and the Americans, if we think of a two-player system, because the Chinese were willing to stymie consumption growth and give us the benefit of the doubt. The reason Powell's hands are more difficult today is we're 40 years in the experiment and we just had negative real rates. So the ability to manipulate the money supply is much more crimped once you get to the zero lower bound. And he's playing really with, he's playing with uranium here. This is something that's very difficult to control, in my opinion. The reserve dominance the U.S. had is slowly slipping. Calling a chart that's going down, that's going to crater, that's hard to do. But we are slowly slipping. I don't know what comes next. What I think is more interesting is that when you're late in this and you've started a fiscal stimulus, Europeans are doing it, populism is growing, I would say be cautious being long currencies. And so in my book, yes, I would rather own more commodities. They act as a good hedge. I would want to be long some real assets that act as a hedge. That's where my head would go. But calling a day, week, and month, I think is very difficult. Most of your audience is unconsciously long dollars. If
Yes.
you're long the S&P, you're long dollars, right? If you're long credit, you're probably long dollars. So there are many ways to think about diversifying that portfolio. I like holding the stocks. On average, the stocks are discounting a very low spot price. When you're in a bull market, you will see the stocks discounting a higher spot price than we have. Today we have the inverse. So since we're in a bear market, I'd rather own the commodities. Once we enter a full-fledged bull, then you may be safer owning the actual index. As you know, I'm kind of a cash flow hoard here, and I'm looking for companies generating cash flow and they give it back to shareholders. What's not being written enough about is the leading companies are acting in a much more capital efficient way than they have the prior 2 decades. So I do believe equities do outperform on the gold side, even though that has not been the case the last decade.
Economists have been making predictions about a possible recession for quite some time now. These forecasters continue to assess the likelihood of an economic downturn occurring within the next 12 months. David predicted that it is unlikely for a recession to occur in the next few months or years. Soft landing is the phenomenon when the economy gradually slows down after a period of growth. Central banks raise interest rates to manage inflation and achieve this soft landing, but it's not always successful. David argued that the current system of relying on interest rate cuts to stimulate the economy during recessions may no longer be effective. David added that the belief in a smooth and gentle economic slowdown is incorrect. Let's watch David Daglio's interview.
Look, there's 2 questions in there, Danielle. The first is, I think the most interesting is, why did everyone get it wrong? And as someone who's built economic models for 30 years, I have empathy and sympathy for them. The most important thing in everyone's economic model is the shape of the yield curve. And when the yield curve is steep, that means banks want to lend more. And when the yield curve is flat, they want to lend less. And what we saw was a really flat yield curve. And that meant to economic forecasters the world was going to slow. What they missed was banks were going to slow. We saw Silicon Valley and the others struggle. But the shadow banking industry is now 2x the size of the regular banking industry. So the question we should have been asking last year is, if the banks slow, will the shadow banking industry slow down? And it did not. And I think that's why we called it wrong. You know, what does the market say today? The market believes on every indicator that we follow that it's unlikely we will have a recession, or if we do, it will be soft in the next 2 months or 2 years. And that's what the market's discounting. I think the wrong narrative is we're going to have a soft landing. Soft landings only exist in storybook endings. And so where I think we are with the economy right now, we've started to see those drips, right? And when I start to measure how many drips we have, Silicon Valley was the first drip. What that set off was tightening from banks around the world, not just in the United States. And if you look at the senior loan officer survey, you would see it's quite tight, and my guess is by July it'll be the tightest it's been since 2008. The next thing I like to look at is, what is the rest of the lending environment doing? And what we can see from the consumer is the consumer's becoming a little tight. And you can see it in 30 days and 90-day delinquencies. You begin to see them being later. The place that is not slowed is private equity, venture capital, levered lending, the entire private credit market. And that, to me, when that begins to slow, or we sniff out problems there, that's when we're going to see not a soft landing, but a harder landing. Here's the system we have today, is that starting in 1991, we got a recession. We cut real rates by 200 basis points. The economy went. It took off. 2001, we have another recession. That was because of telecom. We cut rates 200 basis points. The economy took off. We did the same in 2008, and then we did it again in COVID. So 200 minus 200 minus 200 minus 200 got us to minus 200 during COVID. If you look at something called the Wu-Chan Index, I think that's what it's called. It's from MIT, which shows you the real rates. At minus 200, there is not that's what caused the inflation. The world doesn't work that way. And so I think we are at the end of this system where the Federal Reserve can always cut real rates to save the recession. And it's why I've been so angry with the soft landing folks. What I would prefer they say is, we can only have a soft landing if you believe we can cut real rates by another 200. And I don't think that's possible. I don't think there's any chance we can do that. We already saw what happened in Great Britain when that happened.
Gold prices are on the rise, trade above the $1,960 level early on Thursday due to a decline in real U.S. yields and a weaker dollar. Investors are confident in gold as a safe haven asset, and the price could reach new heights if it breaks through some resistance level. What do you think about David Daglio's predictions about the future of gold? Do you agree with his assessment? That's all from us. If you like this video, please like, share and subscribe our channel and click the bell icon to be notified of future videos. We hope our content has helped you in your trading endeavors.